Welcome back, everybody, to the Real Perspectives podcast. My name is Vladimir Bosanac. I'm the co-founder and publisher of the Registry and your co-host here today, joined by David Arscott from Baycrest Capital. David, how are you?
Doing well, Vlad. Good to see you again.
Same here, same here. Where do we find you today?
Sitting at home in my home office here, where you can find me most of the time, and relieved to have the kids at summer camp, so it's a little bit quieter around here, which is a welcome change. A little easier to get work done. So
welcome relief. No, totally. Yep. The summer's off to a hot start. Definitely, I think in the commercial real estate space, and we're going to talk about that a little bit. We have a few interesting topics here to cover, including some of the most recent kind of activities from leasing, development, and acquisitions. Obviously, lots going on, so lot to tackle. So why don't we get started? Our first topic, David, you're going to talk about is construction, right?
Yeah, construction, and the headline that jumped out at me, they were saying second quarter deliveries, construction deliveries in the commercial real estate space are down at their lowest level since 2011. So that's 15 years ago. We've obviously seen some boom and bust in construction, but it's interesting to hear that and see that on a national level. All the supply constraint issues and other factors that are driving up cost of construction are a big factor.
Yeah.
And then obviously there's a lag between construction activity and the planning, right? It takes a long time to get these development deals in place. And so last couple of years, we had softening cap rates, some rental rates dropping in certain product types. And so I think that's starting to catch up to the market. And then I've had conversations with some brokers around the country who are noticing, less construction activity, which will hopefully allow some of those market fundamentals to rebound a little bit in some places, maybe where there was overbuilding or where you have a little bit of oversupply. So I've definitely seen that on the industrial side and really more on the multifamily side, actually, in some of these big markets where we've seen a lot of construction.
Yeah, some of the markets definitely have been oversupplied, right, in terms of multifamily. So I can definitely see kind of the challenges there. Are you from the data that you see on the kind of reduced construction activity? Is this based on billings? People hired, number of projects. What is kind of the figure that they're using to measure this?
I think that's total deliveries, right? So the number of square feet or units that are delivered to the market. So, it makes sense to see that softening a little bit as these lower valuations sort of catch up with things. I mean, a lot of properties that were, and on the debt acquisition side, I'm kind of seeing this, right? Properties that refinanced or were purchased in 2023, 2024, maybe early 24, those cap rates were a lot lower than they are today. And so, the values are definitely coming down. And so that just runs its way all the way up the chain to development, right? And what a developer can underwrite in terms of the rents they're expecting and then the ultimate value that they're expecting on a property. So with cost going up and valuations coming down a little bit, I think it's a very natural thing to see. And then in some markets, I mean, I think we talked about it last time, Vlad, Austin, Denver, Nashville to a certain extent, Miami, certainly, markets that are pretty hot or were pretty hot just totally got overbuilt. And we saw so much construction activity that we're seeing vacancy rates spike, rental rates come down. And so it's natural to see, some softening on the construction side, especially because those high costs aren't going anywhere in today's economy. So
yeah, that definitely seems to be the case. I mean, even with during COVID, I think with lowered construction and development activity, I think people were anticipating that maybe construction costs are going to go down somehow. They didn't. I think they kept going up. I think that sort of surprised and maybe annoyed a lot of the development folks in the industry. Since then, obviously, we've had a transition in the administration, which impacted supplies of materials because of tariffs and things like that, and also labor's been an issue, right? It continues to sort of strain the industry, I think, in many different ways. Now, what's interesting about that is anecdotally, at least here in the Bay Area, where you and I live, I have seen construction companies continue to advertise for jobs very openly, and they are telling me, again, this is all anecdotal. I don't have specific figures to sort of cite, but just from looking at maybe 4 or 5 kind of prominent construction firms here, they do seem like they can't find enough people, which is interesting. And I don't know if that's because of some of these issues that I mentioned around labor and immigration, that kind of thing, or just they're getting ready to ramp up a lot of development, and we just haven't heard about it yet, right?
Yeah, it's a great point, and it's actually really interesting to hear that because because in general it does seem like construction's been softening, but around here we also have a specific set of economic issues going on, and AI and everything else that we're seeing, the atmosphere, the massive amount of growth that we're seeing on that front, I think is trickling down into other parts of the economy. And actually, you give me a pretty good segue into the second topic that we were going to discuss, which is new capital deployment into data centers.
Right.
And I'm wondering if some of that activity that you're seeing on the construction side, the contractors, the builders looking for more labor, if that's related at all to all of the boom that we've had in data center construction and data center investment.
Yes.
The big highlight on that is just the massive amount of new capital that's being deployed towards data centers. And as a person who's been watching the real estate market and different product types kind of ebbing and flowing over the years, right? We had in the Bay Area lots of life science activity. We know that life science vacancy rates are really high, and rents are starting to respond to that because they have to, because that we were kind of overbuilt in that. But industrial outdoor storage and now data center construction. Vlad, tell me about you guys had an article just recently about data center vacancy, right?
Yeah, to circle back to your earlier point, yes, where there is an increased level of construction activity, it seems to be in the data center space, and this is, I think, across the country. So obviously, driven by the fact that we are basically at zero vacancy in data centers. That's the report that you're referencing that we published last week. It's no surprise. I think AI is definitely becoming, a big economic driving, engine for the entire country, maybe the entire world going forward. And data centers will continue to play a very important role there. Interestingly, with that, however, there is quite a bit of kind of popular pushback on data center development, and I don't really know how this is going to play out, but some of the things that we are seeing right now, how it's playing out. For instance, there's 2 examples that I'll bring up, both from the West Coast, obviously, but I know that there are similar proposals elsewhere in the country. But the city of Monterey Park, which is kind of a city in Los Angeles County, just passed a law recently. It was voted recently that no data centers are going to be built, or that the city will not allow any data centers built within its limits. Similarly, not as strong of an ordinance, but there was recently law also passed in the city of Seattle, where they put a moratorium of any data center development in the next 12 months. So I don't know how long that's going to last. I don't think it will, because I think data centers will continue to be an important part of the economy. There's already proposals to kind of repurpose some buildings downtown Seattle, for instance, right? I think they're just waiting for that clock on those, 12 months to, expire. But, we're seeing stories in other parts of the country. I want to say, I believe I saw something in the Northeast, certainly in the Midwest. There are some stories about this too. So while there is activity, this is where things are happening, and this is where I think development dollars are going in. There is some pushback, and I don't think it's going to be something that goes away, right?
The pushback is an interesting point because, I was reading an article in CoStar about investments in data centers overtaking office, right? And so, obviously office has had a lot of challenges. I think in our last conversation, we talked about office in San Francisco and the big AI leasing boom and all that. But all that notwithstanding, office is a product type that we've been seeing for, 100+ years now, right? Whereas data centers are just taking off and they're already overtaking office in terms of investment. So the point you bring up about Monterey Park and Seattle putting moratoriums and or pauses on, development of data centers is interesting because it could actually create a lot of opportunities in places where they are open to data center development. Maybe people who would prefer to be in Seattle will look into, I know the Columbia River Valley is a popular place, on the border of Washington and Oregon, maybe some less populated areas where they can do that. I know a lot of developments occurred in Utah, west of Provo. And, and you bring up again, I mean, I know in Wisconsin, there's been a lot of public opposition to data centers coming into town. And, they take up a lot of energy, they take up a lot of real estate, they don't add a lot of jobs. And so people, I think, are cognizant of that. But investors are demanding data centers, and tenants, users are demanding data centers, Facebook and Google and all the big companies.
100%. Yes, 100%.
So
and I think
they're going to go somewhere.
I think the energy issue will be an issue that we're going to have to resolve. I don't think it's going to be something that we can just kind of tuck under the carpet, hope that it gets better. I don't think gas turbines and coal and whatever is a solution for these kinds of things. Mm-hmm. We're already seeing in other parts of the world from some of the information that I've seen on podcasts and reading articles, energy in China is not an issue, for instance, right? Spain, all of a sudden, I saw another article yesterday, as a matter of fact, that said they have an oversupply of solar power. There's so much solar power that they're sort of issuing negative rates for their customers. I think we're kind of in this sort of middle ground of squeeze between politics and energy industry that is trying to be focused on coal and sort of natural gas and sort of that kind of thing. And I think as soon as maybe a new administration has to come to sort of change that, but I do believe there's a lot of opportunity both for development and construction and for financing that will have to build this infrastructure, including renewing the grid, right? Because the grid was built basically not with the idea of having all these data centers and all this kind of power sort of come through it. So I do see that as a huge opportunity for the commercial real estate space, and I think eventually we will begin to develop more in that area.
Yeah, and this isn't a politics podcast, but it's interesting the political point that you bring up, right? For so many years, we had a lot of government, incentives and sort of nudging, pushing people towards green development, solar, wind, other
energy independence, essentially, right?
Exactly. And then the current administration has said, no way, let's get all the coal and natural gas out of the ground. But with all this data center development, we need more energy, and we need to find it in ways that we can pop it up, right? And maybe if you build a bunch of data centers, nobody wants a big dirty coal plant next door. But if, it might spur development in green energy that the government was previously doing with subsidies, we actually now have a market force that could be pushing
That's right.
that. So that's
Yeah,
an interesting point.
and
That's
a
a really
very, very
interesting
healthy
point.
market too, right? So, yeah, I think it'll be exciting. I think nuclear is a big, part of that. I think I read something recently. France has something, I think like 87 or 89 nuclear plants. I don't know how many we have in the U.S. I don't think it's as high, but obviously that's one opportunity too for growth. I know they take quite a bit of time to be developed, but there's also innovation there that we haven't explored. I think nuclear kind of has kind of this dirty undertone in the U.S., right? As it's sort of dangerous, and David, you and I probably grew up watching The Day After when we were kids, and then sort of the apocalyptic kind of post nuclear world, right? But I don't think that we need to get there, right? I mean, I think that there's some new ways, there's some micro nuclear plants that can be built, and things like that. I'm actually quite optimistic, about this sort of energy space, and I think in the next couple of decades it'll be, I think, a driver of growth in this country.
Definitely. Interesting tie-in with commercial real estate with data center boom as well. So
yeah, for sure.
good.
One of my topics today is something that I kind of noticed. This is bit of anecdotal, where we've seen some reporting on it, but not a lot of details yet. But I think with the kind of I would say we're in the news cycle. I think that's sort of obvious, right? This news cycle certainly seems to be shaped by innovation in artificial intelligence. Most of it driven here on the West Coast. So my perspective is West Coast based, but I would love to sort of hear from others if they're seeing something similar happening across the country. But certainly on the West Coast, we're beginning to see submarkets in certain areas where like an urban center that maybe was really impacted by COVID and hasn't recovered as well as maybe some suburban submarkets have. What comes to mind is like downtown Portland, for instance, right? Even downtown Seattle in some cases, right? Parts of downtown San Francisco, right? Places like that. It seems like what used to be properties that were considered subpar, or properties that were considered very difficult to lease, are beginning to kind of get that value play in terms of leasing, value play in terms of potential acquisitions, right? And I think it's beginning to happen. And I'm seeing a lot of kind of anecdotal and actual deals happening that's making me believe that we're going to see a resurgence across the board. David, what do you think? Are you seeing similar stuff?
I am seeing similar stuff, and to start in our backyard again with a San Francisco story. There was recently a take back of a 5 million square foot office building in Soma, 415 Natoma Street, which is the newest office building in San Francisco, and had a hard time leasing it. I think the submarket is a little bit tricky for office leasing there, which I think has contributed to some of the challenges with the property. But the new owners now have a much lower basis. They're in there, tying back into our original conversation about construction, they're in there at below construction cost. And so that change in basis will allow them to be more aggressive with leasing terms, with leasing rates, which will hopefully allow them to help fill up that building, maybe draw some tenants in who are being priced out with the AI boom and everything. It's with office around the country, so many properties were hurt so badly in COVID. Yeah. And, with all these big tenants taking smaller and smaller office spaces and hybrid work and all the buzzwords that we've been hearing for 10 years now, it has taken a toll on office. And so people are really having to rethink it. And, I think in our last discussion, we talked a little bit about residential conversions and all that kind of stuff. But those activities are taking office out of the market. And
Right.
so as we see some momentum in the office leasing, I think you're absolutely right. People are able to make those bets on buildings that they wouldn't have touched 10 years ago or 5 years ago, but buildings where they're close enough to the urban core, where they're seeing some momentum in the area, where they can sort of develop momentum in the area with a lower basis. I think that there's definitely some of that going on. And anecdotally too, a little bit different, not within the office space, but within multifamily. I've heard from around the country people talking about investors seeking yield, right? Going into markets where they maybe weren't as comfortable before, or where they haven't been before, looking for higher cap rates where it's a little bit easier to make a deal pencil. And so I think that that's
Yes.
an important driver. Value is an important driver of a lot of
100%.
the commercial real estate activity that we're seeing today.
100%. And we've seen those valuations drop quite significantly. I think the building that you mentioned, I believe, just recently traded for about $300 a foot. That is a basis that just 5, 7, 8 years ago was unthinkable in San Francisco, especially for a brand new building. Buildings like that used to trade in the sort of 2018, 2019 time frame, in the 900s, right, per foot. So now that you have a new operator, at a third, let's say a third of that, volume, you're resetting everything. You're resetting what you can lease it for, right? And I believe that, they're finally beginning to see activity throughout the city, right? So we had positive absorption in San Francisco. And again, this is probably happening in other parts of the country too, but, it's beginning to happen. These companies that are, coming in, these investors are now basically saying, this is a great buying opportunity. And then I think my point was that this is, I think, where some of the value add will happen over the next maybe 12, 18 months. We recently had Jeff Weidel from Northmarq on this podcast, and we were specifically asking him, where are we in this kind of cycle of, the reworks being kind of done, or the sales of these distressed properties, and he felt we were still at about halfway through. So not nearly as sort of through the process of kind of where we need to be. So that just tells me that more of this stuff is going to happen. I think the value add stuff will come in the form of distressed property, right, where either the lender or the owner, they just can't push the can anymore, right? And I think we're starting to see that. So, and with activity, obviously, I mean, obviously there is a market now for these properties, and folks that are willing to put money are beginning to see that the leasing market is beginning to move again, right? Which brings us to another talking point about employment. I mean, even with sort of some of the challenges that this country has had, unemployment has been very robust. I mean, it seems to kind of stay relatively low. Unemployment is staying relatively low, even with inflation, economic issues, and all these other things, right? So that points to some health in the industry.
Definitely. Yeah. Excellent.
Yeah. So I anticipate that to happen some more. And speaking of kind of where the economy is, this is my kind of last point on our conversation here, David. Recently, we saw a report come from Goldman Sachs, which pegged the probability of a recession in the U.S. something to about 15%. That's 15%. They reduced the probability from a higher number. So I think what they're basically saying is they're not anticipating recession coming to the country soon. However, the biggest reason for that is the fact that they're anticipating the oil prices to begin to go down at some point in the second half of the year, with hopefully the resolution of the the sort of Iran war, whatever we want to call it, right? However, they are a little bit concerned about the hawkish Fed, meaning there is going to be probably a push to increase interest rates. And I think that is going to be spurred by higher inflation, which does not seem to be coming down. If oil prices come down, maybe, but other things have not been coming down. And the other thing that they're sort of worried about is tied to the sorry, I'm going to have to edit this portion. I lost my train of thought here.
All good.
Let me see. What was their second point here? I'll start again.
Okay.
AI valuations, of course. Yeah.
Oh, right.
Yeah. Okay. So some of the things that they're seeing, some of the things that they are concerned about, obviously, is the let me start again.
All good.
So there are a couple of things that they are concerned about. Primarily, they are worried that a hawkish Fed is going to continue to raise interest rates, and obviously, the inflation, if oil prices come down, that certainly will have a positive impact on inflation. However, it's not the only measure of inflation. There's obviously housing, food, and other things. Those things don't seem to have any propensity of coming down once they go up. So I'm curious how that will happen. And then the second thing that they're also worried about is the valuations within the AI sector. It's difficult to sort of predict if there is a bubble burst in that space. I would argue, I think it's difficult to say how that will play itself out to the rest of the economy. These are still private companies, so my thinking is the impact will probably be on those companies specifically. However, if institutional capital is involved, if you have a lot of pension funds and places like that putting money in AI, and all of a sudden there's a devaluation, clearly that will have an impact on other parts of the economy too. What are your thoughts on this?
Yeah, it's a great thought, and on the real estate side, I hadn't really thought about this until you brought up this this concept and this idea of when we'll have a recession, what the odds are, et cetera, right? The bears are always going to find a reason for a recession to be coming, and the bulls are always going to find a reason for no recession to come, right? So, but it's interesting because a lot of what we're seeing on the real estate side is it's really fundamentals that are driving these things, right? With the construction stuff that we talked about earlier, we had valuations come down and softening demand on the tenant side, which has resulted in lower construction activity, right? I mean, that's directly, and those things are all tied to the greater economy, right? If we had a stock market crash, obviously demand for everything goes down, right? When you bring up the AI valuations, I can't help but think about the dot-com bubble, which was 25 years ago now, and that burst right in the Bay Area, and that was the last major shock to the system. I mean, COVID was a major shock, but it was just so acute. The dot-com bust was really even bigger than the Great Recession in terms of values and everything in the Bay Area, right? We've seen these giant ballooning values in all product types, but not all product types. As you pointed out, value in office, we're seeing that kind of reset right now. But in residential real estate, I mean, the price per foot just keeps going up in every market, and certainly
Right.
where I live. And those numbers are going to keep going up. I worry that some of those AI valuations, these companies, they're tied enough into the global economic network, and enough people are making bets that if something were to happen, or if you saw major consolidation or major changing in things that are happening on that front, that could be enough to spur a recession nationwide. I mean,
I totally agree. Though the one distinction I would say from the early 2000s to now, I think in terms of the valuation, I think the concentration of wealth, is higher today than it maybe was, those almost 30 years ago now, right?
Yeah.
We have fewer investors, fewer people kind of touching this, big elephant, if you will. I don't know what the right metaphor here is. But my point is there are fewer, it's not like we have, banks investing. I mean, maybe they are. I shouldn't say that, right? But I think the exposure to the AI sector could be more limited. I could be totally wrong. There might be, tentacles, tied to all sorts of, retail investors and everybody that, will really impact the economy as a whole if one of these, bubbles burst. Now, having said that, even in the dot-com bust, we did have a proliferation of technology following that bust, right? So, the internet did not go away. If anything, it just became better, bigger, stronger. It became the backbone of the economy, right? And I do believe similarly, even if some of the valuations of AI companies today are astronomical and not real, and we can argue over that, this technology is not going away. It will be used in manufacturing, it'll be used in healthcare, it'll be used in education, it'll be used in banking, it'll be used in defense and military applications. It's just going to be with us for at least your and my lives, right? And certainly going forward.
Yeah. Oh, definitely. Good. Very good point.
Yeah. So, all right. Well, we're at a point of our conversation here where what we'd like to call Microscope telescope, and where we focus on something very, very closely, or kind of zoom out and take a perspective on a topic that is super interesting. I'll kick us off here, David, if you don't mind. So we all know that there's going to be some IPOs happening this year, likely or shortly, right? The AI impact, I think, on housing has already begun, at least in the Bay Area. We're seeing prices for upper echelon homes, escalate a lot faster than mid-level or entry-level homes, right? That just tells you there's more people with money coming out of this sort of out of this space. Once the IPO happens, we're going to have probably a lot more millionaires, right? That is beginning to happen. I think the SpaceX IPO also has impacted housing in Orange County. I'm seeing some reports where prices there have began to grow quite a bit. And I don't know how this is going to play throughout the country, but certainly in markets where these companies have offices, or certainly where there is similar kind of technology, we're going to, I think, see an escalation in home prices. Thoughts?
Yeah, I think that's definitely true, and anecdotally, you and I see it every day out here in the Bay Area. You keep seeing the price per foot go up and up and up. I got a Facebook friend and friend who's a realtor posted about a property they just sold around here, which was $1,700 a foot, and we would never have thought about that kind of pricing even 5 years ago.
So that means 1,000 square foot home, which is like your typical kind of 2-1, like little Rambler from the 1950s, right? Would go for 1.7 million. That's what that means.
Yep, exactly. So, and this was a little bit big. I mean, not big, but a little bit bigger, 1,380 feet, and 3-bed, 2-bath. And my wife said, how can they fit all those bedrooms in that small of a house? But, I mean, this is the world that we're living in now. And so in the Bay Area, certainly. And so the valuations are crazy. I mean, it'll be interesting to see if there are other places where you start to have booms like that. I think for a while, Austin, Texas was probably, in that realm, but overbuilding and a large supply of land probably kind of cut into some of those major price spikes like we've seen in the Bay Area. But yeah, to your point, Southern California, Seattle, San Francisco, definitely areas where some of those IPOs could have an impact on the residential market. And, in the Bay Area already, in my neighborhood, it feels like most of the deals are all cash. Interest rates don't really play into
Right.
the economics of it very much. Whereas in most markets around the country, those interest rates are a huge deal because that's what people are buying based off of. Whereas in our IPO crazy land, we have people with wads of cash in their pockets. So
that's true. That's
amazing.
true. And conversely, I think we've also seen kind of the, value buyer has been shifting, right? I mean, I think you and I have seen, parts of the Southeast have become more expensive, right? And unaffordable to the point where now markets in the Midwest are picking up in terms of interest in a sense, because now people are looking at, Chicago and, Kansas City and places like that because they can afford a home there. So they become more interesting. The, supply side, I think, is going to be an issue for sure. The one kind of, I don't know if I want to call this sort of in a silver lining, but it's not necessarily a silver lining. It's more of kind of a casualty of some of the latest policies. But I believe that we have, for the first time in history of our country, recorded a decrease in population. Right, a decrease in population means also less demand for housing, that kind of stuff. It also means slower GDP, right? Now, how long that's going to last and whether that's sort of a kind of a blip or really continues to happen longer than just this one time, we'll have to wait and see. But something tells me that even with the decrease in population, I think some of the valuations are not going to go down simply because we just don't have enough housing, right? And that continues to challenge the industry, right?
Definitely a shortage and high construction costs. We already talked about make it
That's
continue
right.
to make it difficult to build more houses and more housing. Not to mention local opposition in more supply constrained markets like ours. So, yeah.
Yeah, for sure.
All
And
right.
David, I'll let you close off the conversation here.
Yeah, our little microscope topic, and this was just a headline that I saw about a big refinancing for some Phoenix industrial space, $122 million bridge loan JLL had announced, which kind of got me diving into Phoenix. I haven't worked too much in that market, so it was interesting to sort of pull back and take a look at that. But in early 2023, the industrial vacancy rate in Phoenix was about 4%. And that was, kind of, I would say, related to the even lower vacancy rates we were seeing in our coastal markets in Los Angeles, Inland Empire, San Francisco Bay Area, obviously, and even the Central Valley. But, Central Valley, Vegas, Phoenix, all sort of experience an overflow effect from California. And so with super low vacancy out here, we saw a pretty low vacancy out there as well, quite low out there. Vacancy in Phoenix skyrocketed to above 12%, and this is based on CoStar data in 2025, and has since decreased.
That's within 2 years only.
2 years only, or 2 years exactly, two and a half years. It went from 4% to over 12%. So massive amount of increase in vacancy. New construction as well, tying into all the subjects we've been discussing, but they had quite a bit of new construction. A lot of people anticipating that demand from the coastal markets. And Phoenix has a lot of its own economic drivers with manufacturing and tech and obviously logistics as well. So, but even with all that, too much construction, not quite enough demand, or softening demand, booming up vacancy. And then now in the last couple quarters, vacancies dropped to 10.5%. So hopefully moving back in the right direction. Construction slowed down a bit, but has seemed to come back up a little bit in the Phoenix market. And obviously I'm no Phoenix expert. This is just something that I popped up on because of this headline, but it's interesting to see that sort of boom and bust cycle within the industrial market, which was so strong a few years ago. And, but to the point of the initial headline, $122 million bridge loan on a bunch of industrial space in Phoenix is an indication of, the market believing in that recovery, in tightening constraints, tightening conditions there, tightening fundamentals. So it'll be interesting to see how that plays out.
And another thing that we've seen with bridge lending recently, there's been a couple of reports about this, that bridge lending is becoming more mainstream, kind of as a sort of a real source of lending compared to its, usual sort of use, right? Which is, short term kind of overcoming a certain obstacle or something like that, right? And so there are a number of different issues tied to that, including that it's, obviously higher risk, right? Higher cost. But in some cases, I think because some of the challenges with sort of, typical lending is, right, we're seeing some of these, private folks being able to come in and do some, creative stuff. So that's another thing that we're kind of, tracking, but it is interesting, kind of unrelated specifically to Phoenix, but, related in the sense that it's sort of a, bridge loan that kind of spurred your interest in this market. So
Definitely. Well, good.
Anyway, well, David, this was great. Thank you all for joining us. And David, good to see you again. Looking forward to our next iteration of this in a few weeks. Until then, stay safe, and we'll be in touch.
Sounds good, Vlad. Great seeing you as well, and look forward to catching up again soon.